This deal had everything working against it. The appraisal came in lower than we needed, and there was a business partner who wanted off the loan as fast as possible and was not easy to deal with. The clock was also ticking because the longer that this thing dragged out, the worse that it got for everybody who was involved. But the property was making serious money as a short-term rental. My clients were already seasoned investors, and we had done multiple deals together before. We found a way to get it done. Welcome back to another deal of the week. If you're new here, my name is Ricardo Carrillo. I'm the founder of RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US, including Puerto Rico, secure financing for both residential and commercial deals. Whether you're buying your first home or scaling your real estate portfolio, my team and I will take you through the entire process from A to Z. The whole point of these videos is to show you real deals with real numbers about real clients and exactly how they're structured so that you can understand what's actually possible when you do real estate investing the right way. Here's the backstory. My clients own a short-term rental property that we helped them purchase in West Virginia. Airbnb, VRBO, vacation rental essentially, and this property had appraised for $664,000. It had been operating as a short-term rental with already more than 12 months of rental income. It had solid occupancy, great revenue, pretty much the kind of numbers that would give a lender real confidence. And the issue had absolutely nothing to do with the property or the income. One of the two business partners on the existing deal wanted to be completely out. He no longer wanted to be on the debt. He no longer wanted to be on title for the property and no longer wanted really any connection to the asset. He wanted this also handled as quickly as possible, which meant that we needed to do a refinance, not necessarily to pull cash out, and also not necessarily to get a dramatically better interest rate, but really to just remove him from the loan completely and leave the other partners as the sole owners for this deal. The loan program that we ended up using for this is called a DSCR loan, which stands for debt service coverage ratio. And I want to explain why this was the right fit for this exact situation. Now, DSCR loans are really designed specifically for real estate investors. Unlike a conventional loan where a bank is looking at your W-2s or your tax returns, and you also have a personal debt to income ratio, a DSCR loan is underwritten completely different. It's actually based off entirely on the property's rental income. And the lender basically just asks one question: does the rental income cover the monthly payment, and by what margin, essentially? The ratio of the rental income to that payment is your debt service ratio. And what they're looking for is a ratio that's over 1.0, which means that the property can cash flow. It can pay for the mortgage and then some. And a strong ratio that's above 1.0 will actually give the lenders real comfort and oftentimes even get you better interest rates or better terms on the loan. Now, here's where a short-term rental like this would fit into that. Short-term rental income like Airbnb, VRBO, and platforms like that could absolutely be used to qualify for DSCR loans. But you have to also have documentation. Lenders typically want to see that you have at least 12 months worth of rental income so that they can cover and make sure that the covering of the mortgage could happen with you having enough rental income that you're bringing in, not just basing it off of projections. And we had documentation for that. We had 12 months of documented short-term rental income showing that the property was performing well above what it needed to in order to be able to debt service. And it was also in order to be able to debt service that new debt. And so the debt service ratio was not the problem. It wasn't even really close to being the issue. The problem was the appraisal. The property came in at 664. We were way overestimating what it was going to be. And I want to also be careful here because all the numbers of the deal sound solid, and for deals just like this, it would be awesome. But when you're refinancing with specific existing loans that you already have, and at the same time like this, you're removing a partner, the appraised value has to hit a certain threshold in order to keep the loan to value ratio within those acceptable limits. Now, when the value comes in lower than when you need it to, like your loan to value, for example, could get pushed in the wrong direction. And that ends up making it so that you as the borrower have to bring in more money to close, which might have not been part of the original plan. Ultimately, in plain terms, the loan to value is the percentage of the property's value to the financing amount. So the higher the appraised value, the more wiggle room that you will have for your loan to value. When the appraisal comes in too low, you have less wiggle room. And so what happens is someone ends up having to make the difference. On a deal like this, where the client is having a partner who's leaving, it's already difficult, and then pushing for speed on top of that could already create more friction. Also then telling the remaining partner that he has to actually bring money to the table is not necessarily a conversation that a lot of business partners would want to have. So what we ended up doing was we looked for a problem on the interest rate side with the banks and what we could control. We couldn't control and change the appraisal. That number, it is what it is. What we could control though was how the interest rates structured and what our client picked, and also how we built the loan to minimize what the remaining partner had to bring out of pocket. So we basically engineered the loan terms to get the out of pocket cost as low as possible, given this constraint that we had. This is essentially what an experienced team like ours does. When one variable is locked, you find the other variables that you can move. And so the new loan ended up coming in at $531,000 with an 8.3% interest rate on a 30-year fixed mortgage. Monthly principal and interest was just a little bit over $4,000, and the total payment, which also included property taxes of $170 a month, as well as homeowners insurance of $230 per month, that left us with a total escrow of $400, came in to $4,400 per month. And cash to close for the refinance came in at $14,000. Now, given the appraisal challenge, because it came in low, getting to that number was ultimately a win. And I also want to talk about the speed element, because it's a real and constant pressure on deals just like this. The partner who wants to get removed is difficult from start to finish, and he also wanted to be on the loan. He also wanted to be off the loan, and he wasn't being patient about it. So every single week that this had dragged out, it just meant more tension, more friction to the business relationship for our clients, and then also more uncertainty for the partner who was trying to be the one keeping the asset for the long term. Now, my team moved fast. We prioritized the loan. We stayed on top of all the documentation and overly communicated with every single person in the transaction constantly, which kept the deal from stalling. And on deals like this, speed is not necessarily like a nice thing to have. It's really part of the service that my team and I are delivering. Here's the full recap. It was a short-term rental property in West Virginia. We appraised at $664,000. We used a DSCR loan to remove a business partner from the loan, and we were able to use the last 12 months of history of short-term rental income in order to qualify. The appraisal came in lower than ideal. We still engineered the interest rate and the structure of the loan in order to minimize that out-of-pocket cost. We had a new loan at $531K with an 8% rate and a monthly payment of $4,400. The deal's closed, the partner's off the loan, and everybody is able to move on. Now, if you own a short-term rental, chances are you've come across a situation like this, or you potentially need to restructure your financing. You have a partner buyout, you have some sort of interest rate adjustment, maybe a time to refinance and get some more to sort of cash out, clean up some debt, pay off investors. My team knows exactly how these deals go and how they work with partners like this. So if you have any issues and you need some help on it, go to rclending.co. You can follow me on Instagram at Richie the Lender. And if you haven't seen my other Deal of the Week videos, you can check those out either here or here. Make sure you also like and subscribe. I will see you guys in the next Deal of the Week.